How did you trade before 2000 year and after? How have market changed since 2000s? Was it easy to make money in the past than today's market? What type of strategies worked back in the day?
Okay, so those are good questions. The first question I think was, what did I do differently before the year 2000? I think year 2000 is that when they had decimalization in the markets. So one of the major changes since I began my trading career was the addition of ECNs, which are the competing markets, which have narrowed the spreads. And one of the other major changes was decimalization. When I first started, stocks were quoted in fractions, and so they would trade at an eighth of a dollar spread or a quarter of a dollar spread. And then this big change was decimalization, where things started to be quoted in pennies. And the idea behind this was that it would be better for investors. Tighter spreads would result in better prices for investors. And so what happened when this change came about, stocks started to move more slowly, because before, when an offer would lift in a stock, it would be 25 cents higher. And it would lift a few times, it would be 50 cents higher. Now, the spreads were in pennies. The offer would lift 10 times, it would be 10 cents higher. And so one of the big things that I do and that I try to teach to the traders that we train is to kind of visualize what I call the natural spread in a stock. You look at the spread and you see that it's only 2 or 3 cents apart, but the reality is there are market making programs, HFT programs, that are narrowing that spread to make it appear it's 2-3 cents apart, but the real liquidity might be 10 cents apart. And so what I do is I try to ignore every single little tick that happens inside of what is the natural spread. And so that's one of the changes that I've made. I guess the second part of your question was it easier to make money? So that's one of the most common things you hear, is this idea that before it was easier to make money, now it's harder to make money. The reality of the situation is, my first trading job, I was at a firm that had a huge technology advantage. They had cutting edge technology, better than any of the large banks. And so I was told from my friend who got me the interview, and before I even started, to say, hey, we have this great technology, but the truth is we have traders, we hire people, and they're awful. They lose money right away despite this technology edge. So the truth is, you can have a technology edge, you can have the best training, but ultimately some people's personalities and some people's behavior, they just don't allow them to be successful in the markets. And so my first job, we had a huge technology edge. They hired hundreds of traders, and very quickly many of the traders were fired and failed in their endeavor. Now, the one thing that I'll say that is different is, in the last, I would say, 10 years or so, since around 2006, 2007, other than during the financial crisis when there was very high volatility, and during that time period I saw a lot of young traders make a lot of money, the volatility has been going down and down each year, to the point where since 2000 and late 2011, early 2012, volatility has been getting lower and lower and lower. For traders who are trading lower time frames, very low volatility makes it more difficult to learn. Having said that, the last really good group of traders that we trained started probably in 2010. They saw one little uptick in volatility in 2011 where volatility went higher. But then since then, the last few years, they've traded in a very low volatility environment. They've become very disciplined traders. And they're doing, each year you can see their numbers getting bigger and bigger. When volatility comes back in the market, which it will, it always eventually does, as the next major crisis comes along, when that volatility comes back, the discipline that they learned becoming successful in a low volatility environment will allow them to be that much better and put up much bigger numbers when the volatility comes back again.
How has your trading style changed during your trading career?
For me, for the most part, the majority of the strategies are the same, and I should go back. Going back to early 2002 or so, we really began to focus in what we call stocks in play, meaning stocks with fresh catalyst, fresh news. I talked a little bit about how overall the market volatility is low, but when you find stocks with fresh news, stocks that beat earnings, or stocks that miss earnings, stocks that raise their guidance for the next quarter and the next year, or a stock maybe that's being investigated by the government, when that happens, the volatility increases because the larger market participants, the hedge funds, the mutual funds, large institutions, they want to get into those companies or they want to get out of those companies. That volatility, that movement from larger players gives us the momentum setups that we actually learned very early in our trading careers. And so one of the things that SMB specializes in, that we teach our new traders and that we actually offer to those in the SMB community through our morning meeting and through the trading tools, SMB Real Time, is what are the best in play stocks for that given day, and what are the most likely patterns for them to follow. So in that respect, those strategies are the same. Now we've added new strategies on top of that. We might do things where we use our technology to find large imbalances on the open or the close. We might use our technology to build models that take advantage of very split-second inefficiencies. But the general strategy of finding momentum, short-term momentum intraday and in a multi-day time frame, those are the same. It's just a question of finding those areas where those things are going on. And we use various tools to spot those opportunities. Trading styles definitely seems to change every few years based on overall changes in the market. But as I had mentioned to you a little bit earlier, since late 2011, early 2012, we've really been in a low volatility environment. And for about 2.5 to 3 years, we would have a small uptick in volatility for 2 or 3 days. The market would come down, volatility would go up, and I would trade momentum for a few days. And then the volatility would go right back down, and then we would start to grind higher. And then I would focus on in-play stocks, momentum stocks again. We've seen a little bit of a change in 2015, since late 2014, where the market has kind of developed these ranges over a period of months. And during that time period, over the last 3, 4, 5 months, what we've done is, as the market's come in towards the bottom of that larger range, we've faded and gotten long the market. And when it's moved up to the top of that range, we've faded, got short the market. But overall, I'd say a lot of the style over the last few years has been very similar, with small changes when we've seen that uptick in volatility for a few days.